Welcome back. We are now busy with Unit 2.3, Life Investment Policies. Right, the learning outcomes that will be covered in the next section will be the following. Describe the general characteristics, the terms and the features of financial products in a life investment policy. Explain the typical fee structures, charges and other costs associated with a life investment policy. Identify the general risks associated with investing, purchasing or transacting in a life investment policy. Describe the investments and risk principles, options and strategies for a life investment policy, and validate the appropriateness of a life investment policy for different types of clients or groups of clients. Right, let's look at the definition for life investment policies. Again, the Insurance Act of 2017 defines an investment policy as follows. An investment policy usually refers to a long-term insurance policy, such as a life policy, with a component of an investment attached to it. An endowment policy are regarded as a long-term insurance investment policy, which means it will pay out at some later stage. Right, let's have a look at the general characteristics, terms and features of an endowment policy. An endowment policy is an investment plan that helps you save over the medium to long term. This investment offers estate benefits and tax-efficient structures. Traditional endowments are made up of a life insurance policy with an underlying investment account. Right, let's look at endowments versus your sinking fund. Suppose you select to have your endowment plan structured with a life assured and the life assured dies before the end of the policy term. In that case, the proceeds will become payable to the chosen beneficiaries. If you select to have an endowment plan structured without a life insured, for example, structured as a sinking fund, the investment will continue after the investor's death until the end of the investment term or until early realization. Right, let's look at withdrawals on an endowment policy. Regarding current legislative restrictions as on March of 2019, one withdrawal is permitted during the first 5 years of your policy. Any withdrawal in the first 5 years may not exceed the contributions accumulated at 5% per year compound interest. After this 5 years, you may make a withdrawal from the investment as required. Right, contributions to an endowment policy. You may make a once-off lump sum contribution or recurring monthly contributions to the endowment plan. If you made a lump sum contribution, then additionally ad hoc contributions into your endowment plan will not be permitted. In this case, a new endowment plan will be started for any additional contributions within another 5-year restriction period. If you have chosen to make recurring monthly contributions, you may also be entitled to make ad hoc contributions to your endowment plan. To prevent the commencement of a new 5-year restricted period, when an ad hoc contribution is made, the value of any of the ad hoc contributions is limited to that of the total contributions, including ad hoc contributions in any given policy year, but will not be more than 120% of the greater of the contributions paid in the previous 2 years. If the contributions is larger than this, the new endowment plan will have to be started with another restricted period of 5 years. Right, let's look at the role of lisps in investment. A linked investment service provider, or a lisp, is an independent administration company that offers investors access to collective investment schemes or unit trusts across several different management companies. One could use a lisp to invest proceeds in one of the following, although each would have different tax implications and fund restrictions. A unit trust investment or an endowment policy, a living annuity or a retirement annuity. It is important to note that a lisp acts purely as an administrator and does not manage the funds or assets that's provided in the investment advice. Right, the typical fee structures, charges, and other costs associated with life investment policies. Stopping or reducing premiums, withdrawal funds, or surrendering one's policy, cancelling before the maturity date are reasons why an insured might incur charges on their policy over and above the agreed fees from the onset. Investment policies normally attract the following fees: the financial advisor's initial fee, or some call it commission. These are the fees that you pay to your financial advisor, who may charge on a consultation basis a fee normally charged upfront, or on an ongoing basis for managing your portfolio. In most instances, advisors prefer an ongoing basis to oversee your portfolio over the lifetime of your investment. As a guideline, you should be wary of advisors that charges you more than 1.5% per annum, excluding VAT, on the ongoing advice fee. 1% would be more applicable. Initial management fees paid to the investment managers of the underlying investment choices you've selected. And then there's also cost for tax recovery. Annual administration fee, which you invest. The investment house must do a certain amount of administration on your investment. It includes carrying out your investment instructions and providing you with investment statements. Administration fees often charged on a sliding scale. The larger your portfolio, the lower your fees become. Administration fees typically range from about 0.096 per annum, excluding VAT, to about 1.25% per annum, excluding VAT. Then the financial advisor's annual fee. Your financial advisor may also charge an annual advice fee as a percentage of your investment fund value for managing your investment fund. This might seem unreasonable, but again, remember, if you had to manage it, it possibly would have been disastrous, whereas your financial advisor have more detail and better knowledge. Units will be redeemed monthly for this as 1/12 of the advice fee selected increased by the VAT. Other fees, any additional fees on offshore assets. Initial fees depends on the size of the investment. For example, if you are making a lump sum contribution to your Discovery Invest endowment plan, your initial fee is based on the size of your contribution. If you invest more than 600,000, you will pay no initial fee. If you pay less than 600,000, you'll pay fees on the tiered structure. Then there's an investment manager's annual fee. The investment managers to your underlying investment choices will normally charge an annual management fee as a percentage of your investment in their fund. This fee is divided by 365 and deducted daily from the unit price provided by the investment. Right, the types of investments chosen depends on several factors, including the type of client that wants to invest, asset type, investment duration, and obviously the investment goal. Asset classes. If we look at shares or equities as an asset class, a share represents a portion of ownership in a company. Companies issue shares to raise money to grow their businesses, which are then bought and sold by investors on stock markets such as the Johannesburg Stock Exchange or the JSE. When an investor buys a share in a company, they are purchasing a portion of the company's profits or losses, which is why these investors are referred to as shareholders. The terms shares and equities are used interchangeably. They are also known as stocks. So if you want to buy a share, a stock, or an equity in, say, Mr. Price, this would all mean the same thing, that you own a part of the company, Mr. Price. If Mr. Price then hopefully grow its business, it would pay you a dividend each year, and eventually you might be able to sell your shares at a profit. Right, another type of investment is bonds or an asset class. A bond is a financial tool that governments use, local authorities, SOEs, and companies to borrow money from investors. When an investor buys a bond, they essentially provide a loan to the bond issuer, in this instance the government or an entity that created the bond. A compensation, investors usually then receive regular interest payments from the bond issuer in return. These interest payments cease on the bond's maturation or expiry date, on which day bond issuers promise to repay investors the original amount loaned. For instance, if you invested 1,000 in a 5-year RSA fixed rate retail savings bond with an 8.5% yield, you will receive 85 Rand, 8.5 times 1,000, in interest each year for 5 years. At the maturity date, you would also be repaid your original 1,000 Rand amount that you invested. Right, the next asset class we can look at is property. There are many ways to invest in property, beginning with buying your own home or investing in a buy-to-let property, or becoming a landlord by buying a lot of properties and renting them out. However, you do not have to invest in a brick and mortar house to invest in property. There's other options that's worth considering, including investing in listed properties through a real estate investment trust, which they call a REIT, R-E-I-T, or a property exchange traded fund, which they call a ETF. Both is accessible via stock exchanges, and you can invest in that way and also benefit from the growth in property. A REIT is a company that owns and often manages income producing real estate, while a property ETF tracks the performance of various listed properties and companies. Another asset class is cash. Cash as an investment refers to investment of money in high interest or fixed deposit bank accounts, or investing in a money market fund that may hold treasury bills, commercial papers, short-term certificates of deposits, which they call CDs, and short-term bonds with maturation dates of less than 1 year. However, while cash investments offer greater capital protection and lower risk, it also offers much lower returns than other asset classes. It is generally not suitable as a long-term investment if you want to defeat the value of eroding impact of inflation, because normally they are very close to or 1% above or below inflation, so your money is eroded over time in a cash investment. Right, money market or cash attracts lower returns, yet it carries lower risk or loss, but it's suitable for capital protection. Bonds, on the other hand, carries a moderate return and expose one to moderate risks of loss. It is suitable for capital protection. Property investments carry also a moderate but to high returns, so you get a little bit better return on them, and expose one to moderate risk of loss. So the risk is a slight bit higher to moderate. It's suitable also for capital growth. And then you can invest obviously in equities. They are far more riskier. At the same time, they also attract very high returns if market factors perform favorably, and they are suitable for capital growth and increasing an investment's real value over a life period. Right, let's look at investor profiles. Investor profile help you determine the following. The risk required, so you can discover whether this client is willing to take high, low, or medium risk. So you can analyze the client's financial goals. The risk capacity, that's the level of risk a client is willing to take to achieve their goals. And then the risk tolerance, what the client is willing to expose themselves to achieve their financial goals. Risk tolerance and capacity depends on the following types of clients. So we've got there in the first block a conservative investor. They've got 1 to 5 years to invest. So typically for them, you'll invest in cash or money market investments, bonds, but there is a risk of inflation for them. Your moderate investor, which is willing to invest for 5 to 10 years, here you can also invest in cash and bonds for protection, and then property and equity for capital growth. And then your aggressive investor, they're willing to invest their money for 10 years plus. There's no capital protection and they seek capital growth. Mainly equities will be attractive investment and even derivatives would be an attractive investment for these clients. Right, the client's risk profile may be influenced by the following: objectives and time frame. Short-term versus long-term objectives. The shorter the term, the less risk you can take. The longer the term, obviously, the more. Access to cash or liquidity. One cannot afford to invest in vehicles that are difficult to convert into cash if he or she does not have an emergency fund for emergency events. So it's important that a client has at least about 6 months cover in an emergency fund if they want to go high risk. Then also the age of the investor. The older one gets, the less is your appetite for riskier investments, because also your time span gets shorter. Existing life protection, those without existing wealth protection measures are likely not to complete the full term of the investment, and they might withdraw the money earlier, and that causes a risk on the investment. Right, the impact of government, monetary and fiscal policies and long-term insurance. If the political environment and policies drives the country to a recession, actuaries find it difficult to price risk. Rate increases and impact on life policies. If the policies drive the country to junk status, the increased downward pressure on a sovereign ratings also places downward pressure on corporate credit ratings. Insurers and financial companies in general are vulnerable to the weaker corporate and sovereign ratings when they look to international markets for funding. So your policy environment can affect your risk. Exchange rates and the impact of long-term insurance products. Currency volatility associated with low economic growth could affect some insurers depending on their risk exposure and capital base. For instance, if risk exposure in a domestic and or a revenue generating capital is locally largely offshore, shocks to the exchange rate could have a real and significant impact on investment revenues. Also, from an offshore perspective, weak confidence in a country's economy could divert foreign financiers' attention away from local companies, including insurers who might need cash or alternative financing. With a currency clause, reinsurers become expensive for local insurers as they battle to match the rand value of the foreign currency that they previously agreed in their clause. Right, what's the general risks of investing, purchasing and transacting in life investment policies? If we consider the South African Reserve Bank's MPC on interest rates when they drop or raise interest rates, what is the investment risk and what is the effect on investments? Right, if you look at cash investments, the less interest on savings and money market accounts if they cut the repo rate. No change will occur for those with fixed interest investments as an interest return on these investments were locked in. Bond yields decline because bond returns become more attractive relative to cash investments instruments. A higher demand for bonds usually increase the price of local bonds and as a result the reduction in yields. This is all in case of a repo rate cut. Equities, the values of equities increase when the interest rates are declining. The property share usually increase in value because the property companies rely on debt to finance properties. So if interest rates go down, obviously people will be more prone to invest in properties. The cut in interest rate should be seen as a reduction in interest expenses, and as a result, it will improve the rental yield for customers. Right, stock market volatility and the impact of stock markets. When the JSE trades takes a knock, it affects the performance of investment-linked life policies. Life investment policies that rely heavily on equities tend to suffer a lot and affect the face value of these policies. Right, the appropriateness of life investment products for different types of clients or client groups. Endowment policies are suitable for the following clients whose, number one, the marginal tax rate is higher than 30% and wants to benefit from tax savings. Anything less than 30% you will not be taxed more on. Like long-term savings, if their goal is 5 to 10 years and they're comfortable with taking risk from market fluctuations and potential capital loss. Right, endowments will not be suitable if you want to make more than one withdrawal before the end of the term and have not passed the restrictive period. If you have high interest bearing debts such as credit cards, personal loans, overdrafts, mortgages, bonds, these should be tackled before investing in an endowment, which is like a savings scheme. The returns after tax cost and fees from the funds in the endowment are unlikely to achieve the same rate as your credit card. So it's better to pay off debt than to invest money because your rate of interest usually is much higher on debt than it is on the money you earn on an investment. That will conclude this section. The next section will be Unit 2.4, where we will discuss fund policies.